Um, and so if anyone does have questions and you want to put them in the chat session, or if you want to put them, or if you want to raise your hand or whatever, it's totally fine. But yeah, I mean, Nana, to kind of play off of what your conversation, having a conversation around policy review. So that was the big thing from your presentation standpoint is understanding policy review. And the thing that I always ask people, in the industry is, yeah, I always like to say, and I stole this from someone else, so don't say that I said it, but your network is your net worth. And if you have people that you've already sold a policy to, right, then what are you doing to follow up with that person? Are you following up with that person is a great question too. Because when you think about it, there's several reasons why people should do policy reviews. So I'll throw it out to everybody to ask the question, what's a good reason to do a policy review? Anybody?
I think just to
Is
make
that
sure that your initial goals, not only your initial goals and objectives are being met, but is your solutions going to be catering for your future needs and requirements?
Yep. Yep. Anybody else?
I had a client this past Monday, so I
Hmm.
went and talked to him, and he already told me he already have life insurance, um, uh, like from 2017. So I said that's okay. Let's go ahead and review it. So I
Hmm.
went and talked to him. The good thing is, um, somehow, a lot of people don't have insurance, and he have taken the insurance, so that I really appreciated that. But
Hmm.
reviewing the policy, um, actually, this is I know I don't even know whether we have that company. It's Farmers, and
Hmm.
it looks like an IUL policy, but the fees and other structures, everything didn't look right, and they had like level premium. And it so I got confused. How should I say all the negatives? I don't want to say all the negatives. So I really appreciated them. So I told them, go get all the information. What is the current money value, or the cash
Hmm.
value. I told them to get all the information, so we will come back and sit down again. But how do you approach these type of clients? I
Yep.
got nervous at that time.
Yeah, no, yeah, I was gonna say that is a really good question is, most of the time you're trying to catch someone and say, do you have life insurance? They're like, no. Well, let me tell you all the reasons why you need it. But then someone already has it, and you're like, shoot, I actually look at that as a great opportunity from a buying standpoint because, like, when you think about it, what we want to do, let's see if I have it here. So, yeah, basically, I did this presentation a while ago, but when you think about the situation where someone already has life insurance, that means they've actually already had the spiel, so it should be an easier conversation. So when you think about life changes, like here, have you gotten married? That's a trigger. Divorced, that's also a trigger to have a conversation for a review. Changing jobs. Have you gotten a promotion? Did you get fired? Or things like that, or started a business or sold one. So there's a huge revenue opportunity with business owners, especially, when it comes to buy-sell agreements and things like that. I was on the phone yesterday. Was it yesterday? Yeah, yesterday with a client who he owned a tech company and he wanted to hear more about key person insurance. So key person is a level below management, but he wanted policies on the management. I was like, that's a buy-sell agreement. Have you talked about a buy-sell? And they're like, well, I don't need to do a buy-sell. I was like, okay, let's kind of take the example in place. Like, all right, say, there's three of us, and I'm going right down the list of the people I can see on screen. So, a Jew, me, and Juan, we're all business owners together, thirds apiece. So, I pass away. Well, you guys still own a third because my share went to my wife. It's an unlimited marital gift or transfer of assets to my wife. So now you guys are doing 50-50, and my wife is getting a third of the proceeds. So the guy was like, "We don't need to worry about that." And I said, "Right now you don't, right? Right
Yeah.
now you don't. But the minute someone passes away, money changes everything." It's a sad situation.
Yeah.
Even if your kid is taking over for you, I would still put it in writing. Because what if your wife all of a sudden is like, no, I'm just gonna sell the business and make millions and the kids are out, whatever. You don't think that would happen, but money can change people. And so all these things like, we talk about life changes are extremely important when people are talking about their policies. So like for your sake, could you, what I would say to the client is why did you buy the policy in the first place? Right? Has that need
Right.
changed?
Yeah,
Right?
they got a new baby now. So
Okay.
actually the reason why he called me was he wanted to have like a child plan, college saving plan for the new
Yeah.
child. The first
Yeah.
one he have a 529. Uh,
Mhm.
so
Well, the big thing always, and I say this to everybody, is you got to make sure the protection is in place first.
mhm.
Because if the protection is not in place, all other building blocks will crumble if that person is no longer there. And that's the part that people don't like to think about. Like I was talking with an agent earlier today, and they were like, well, I want to get an IUL for my kid. He's got a family. And I said, well, you should focus on protection first because a $50,000 IUL, though it's accumulating cash, will not give you $1 million death benefit if you're not there. And which one will help them with college and other things for the kid. So all that stuff is important that we always have to think about protection. So, Drew, from your standpoint this client of yours now has a higher need for coverage and protection because that kid's going to go to college at some point. So the simple numbers I always tell people, 10 times your income plus your mortgage, whatever's left, plus about 150,000 per kid will get you to a simple number to have a conversation around. Now, the mechanics and the reason why State Farm, Farmers, Farm Bureau, anything with a farm in it sells a life insurance policy is not so much the value of the life insurance policy. The products are not good. Sorry if anyone has one. Thankfully, you got covered. However, there are better options. The reason why they do that is it creates a stickier relationship with everything else that they're selling them. Home, auto, and then the third piece would be the insurance. Once you have three, it's a 99% chance they're not going to leave that advisor or agent because they have too many things intertwined in it. So that's the reason behind that.
Got it. I don't want to steal too much of your time, but
That's what we're here for.
like just in case if this policy has an accumulated value
Mhm.
of whatever it is, so we can still roll over this one to if they plan to
Absolutely.
go to a new whatever
Yep,
plan it is. Okay.
absolutely. So, yeah, so let's see if the example I have here kind of plays off of that. So this was a New York Life policy that we did a review for. Married with two kids. So the New York Life policy current death benefit 111,000 with cash value of about 21,459. And um, annual premium was about 878. Dividends, not too much. And again, it was from 2001. The premium's 878. You would think the dividend would be higher, but still not even close to the annual premium. Face value originally was 100K. So you look at that. They also had a John Hancock policy, $1 million, 127,000 in cash, paying 63.50 a year. So total 1.1 million, cash value 148, and total annual premium 72.26. So the interesting thing about insurance today is it's priced a little more thrifty in some situations. Some carriers offer a different value proposition for different ages. So if we looked here at the same premium plus the 1035, we're able to give that client, if it's death benefit focused, $3.1 million. Dollars. We literally gave them $2 million more in coverage for the exact same premium, the exact same the 1035 exchange. We were solving for the face amount, and we were able to give them literally $2 million more in death benefit protection. It's a big deal. Then here is just the 1035 alone. I still was able to beat the current death benefit for the two policies. Now they have $7,000 that they can put towards something different, like say a Roth contribution, because it was around 7 grand. So now you're finding money to help them in different ways. So typically, those are the ways that you would look at a policy review. What's the objective? Do they remember why they bought it initially? And then from there, do they still have that need, or has the need grown or reduced? And the interesting thing about cash value inside of life insurance policies is you don't have to move it to another life insurance policy. If they want to move it to an annuity, they can. So there was an old phrase that someone said to me a long time ago. It's L to A is okay. A to L, no way. So life to annuity is okay. Annuity to life, no way. Because anywhere where the government is going to win, they're okay with you doing. But if you're trying to take something that hasn't been taxed yet and put it into a tax favored product like life insurance, they don't want you to do that. So, depending on what the client's objective is, the cash value, we could look at several options that are available to make sure that they're protected and make sure it's doing what they want it to do, rather than someone coming from farmers and saying, hey, you should get a $50,000 policy, you have a kid. You know, that's not going to do much. But the objective was to get them to buy it to make sure the home and auto stay with them as well. Plain and simple. So, what would you need for a policy review? Very easy. You can get an annual statement. That should tell you enough to start the process. If it's clean, like there is no loans or anything along those lines, a simple statement can be the start of the conversation. Because, like a lot of this information, it actually was derived based off of, the statement. And you can tell a lot, especially with whole life, like a dividend at some point should take over the annual premium, and that's when you can stop actually putting premium into the policy because the dividend is big enough. But the fact that this is 23 years old and you're still not even halfway to the annual premium, to me, that says that the dividends aren't dividending the way they should be, or the way it was probably illustrated in the beginning. And not to step on a soapbox for a second, but there's a lot of people who sell whole life, the dividend paying whole life, using the illustration as gospel. That's just as bad as someone selling an IUL as gospel with the illustration, because the carrier is projecting current dividends. And my original company that I worked with was MetLife. where we sold dividend paying whole life. And I remember in 2009, 10, and 11 saying, oh, this is the lowest dividend we've ever had. Then the next year it dropped again. I was like, well, this is the lowest we've ever had. And then it dropped again. I was like, ah, screw it. Like you're getting dividends. And the other thing too is that a company can declare dividends. Say New York Life says, hey, we're giving an 8% dividend. That doesn't mean everyone is getting 8%. All policies are not created equally. There's better dividends distributed to higher face amounts than lower face amounts. And that's what we found when we were, working at MetLife is, my son had a 25K policy and I got like a nickel for a dividend, literally. And then I'm saying, well, this is not accurate. And they're like, well, 25K policy is different than $1 million face amount, so they're treated differently. So it just depends on the carrier as well from that standpoint. Not saying they're all bad, but what I'm saying is that we as providers of protection, accumulation, we should always make sure that the cash value is a story, not the major selling point. So what I mean by story is what can you use this cash value for? Like if I was a New York Life guy, say you got 21,000, be like, hey, that's a down payment for a car, or that's a down payment for a house, or something like that. You have cash value that you can use. If you're on the other side, you're like, hey, this policy underperformed. You should move it ASAP because it sucks. There's no right or wrong answer. It's a very emotional sale. So, but what do we, to kind of pull it back off the soapbox now, pulling it back to policy reviews, the reason why we do this, when we go back to all these life changes that can happen, these are all touch points to get back in front of your client. And if your client is still happy with what they got and you sold it to them, great. Who else do you know that I could talk to that I could give the same type of service to? So again, your network becomes your net worth because now you're asking for referrals. Do you know of anybody else who may have changed jobs? What do we have when we change jobs? They have an old 401k. There's an annuity conversation. So once again, it just depends on the conversation, and half the game is showing up. So um, I know I pontificated on policy review for quite a bit, but you guys probably all have clients that you've talked to. So I would say, time for action, see what kind of policies. I always say like if it's 5 years or greater, because a lot of people have surrender charges. If you have clients who have term policies, guess what? You can convert them and get the permanent sale. Face amounts of 250K or more. Why do I say that? Because you're looking for cash rich policies and $50,000 face amounts probably don't have enough juice for the squeeze unless they're going to get a really big policy the second time around. It can be a little tough. So these are parameters for pretty sizable tickets. So if you're looking for an annual premium of 5K, that's probably going to be at least $5,000 in your pocket, depending on what you find for them. Um, so these are just guardrails, I would say, for you to kind of look at from the standpoint for policy review. But I don't want to say I beat the dead horse at this point, but does anyone have questions about policy review?
Philip, I have a slightly different question. Uh, on that illustration where you had the two policies for the 48-year-old lady,
Yeah,
uh, I quickly try while you were talking, I quickly tried to run an illustration here, and I took those same parameters, and I'm only getting a death benefit of 961. Where am I going wrong?
961 is in
Yeah,
900,061. Are you using
correct.
Symmetra?
No, I used AGI,
AIG? Well,
AIG.
yeah. Yeah, so you use the 148 and 7,226.
Yes.
And which product did you use? Max Accum
Yes.
or Value
I use
Plus?
the max accumulator.
This is the value. This is the equivalent of the Value Plus. So you'll see it's a level DB, okay?
Okay.
And it's the protection product from Symmetra. So everyone, like I say, everyone's going to be different. And so when you are in a multi-carrier environment, you don't work for one specific company. I had like 11 1099s last year. It was bananas. But, you have to get the right fit for the right client. And so that's why it's important to, kind of diversify that practice in case you need to. We kind of focus on a core five to help us, stay within the parameters, but also still provide a value to the customer. And so here I use Symmetra for this standpoint.
Mr. Patel, did you put the initial premium 155?
Correct. Yeah.
You did that, okay.
Yeah.
And it still
I
didn't
put
give
in the
you any.
1035 exchange.
Yeah. And the 7226, that's an all pay. It's not just stopping after 10 years.
Yeah,
Because
it's an
we're,
option.
yeah. So we're mimicking it from the standpoint of what you would have with a whole life policy. So
Right.
that's why I say, like, some people, like, say the person said, I only want 1.1 million. I'd be like, okay, well, let's solve and figure out how much you could get. I don't have to give you anything. The 1035 alone is going to give me 1.68. So that's where some of those situations can make a lot of sense. Um,
So if I
but
understand
yeah, go
So
ahead.
if I understand that correctly, Philip, whenever you're looking at a whole life policy and trying to replicate the scenario in a permanent policy with level death benefit, you make the premiums uh, to the max.
Well, yeah, because I mean that's the idea of how whole life is. Most
Yeah,
whole life policies, unless like there's some carriers they'll say whole life 10, whole life 20,
yeah,
and then if and this turns into a conversation because then you're going to get the whole life guy or gal involved and they're going to say, "Well, my client only has to pay for 10 years." Okay, is that guaranteed,
right,
right? Now you're relying on a non-guaranteed dividend to cover the cost of your annual premium. And if you look, like here, I'll even show you, not that, again, let's go here to WinFlex. I'll max it out a little bit so you can see. And I'll just show you Mass Mutual, like literally just going to go in and click on it and hit calculate. So we're not really doing anything super crazy, but this is a whole life 100. So that means technically to have the guaranteed million, you have to pay to 100, right? So 45-year-old $1 million face, we're just doing annual. I'm just going to hit calculate. Not doing any bells and whistles, no combo of term and perm. So just a tried and true basic policy. Now, when we pull it up, you're going to see two sides of a ledger. Okay. One side will be the fully guaranteed side. And then you'll see a line going right down the middle, which then on the right-hand side, you'll see it'll say non-guaranteed. Okay. So if we go here, and this is not the illustration, this is a summary. This is the beginning. This is like showing the non-guaranteed rates in an IUL and stuffing the 0% column way down below. So if we go to the actual illustration, it starts here. And I'm going to go to the tabular values that I was talking about. And you'll see here, guaranteed, guaranteed, non-guaranteed values. So if you have someone who's delivered someone a whole life 100 or a custom whole life, which is what you would typically see with New York Life, those are a little trickier because sometimes they can be short pays. But what I would say is you want to explain to them that these annual dividends to get to 21,360, the dividend has to make it to 21,360, which is all the way here at year 21. So if all the dividends are perfect compared to what they were supposed to be, they didn't go down, right? Then you have to wait 20 years before the dividend will capture what the premium is, and then it should be able to continue to rise from there and pay for your premium. But most agents will say, you just have to pay for it for 10 years, and then the dividend will carry the rest. What happens is you'll see the death benefit here is about 1.129. You'll see like a little roller coaster, and it's been notching up with the dividends, but then the dividends are going to eat into the premium or the difference here until it finally gets to that. So you'll see it do this little roller coaster down in death benefit until the dividends can recoup it and then it'll go back up. So if someone tells you that the whole life is a short pay, ask them, is the dividends paying for it or is it guaranteed? Because if it's not guaranteed, dividends, which are not guaranteed, you're going right back into the conversation of how IULs have no guarantee or a 0% column. It's the same conversation. They'll say, well, dividends were paid forever. Well, the 0% column has never happened. So, you're basically getting into a fight. I was going to say something dirty, so I won't, but it's just a conversation that you would want to have to discredit the other person for constantly saying, oh, 0% column means your policy is going to lapse in 20 years. Well, it's not because the 0% column has never happened. Nothing wrong with whole life. Once again, I sell it. It's a top shelf policy for people who don't want to think about it. It works great, but there's different strokes for different folks. So, like, could you to go back to your policy? What type of product is it? How much cash value is in it? What's the monthly or annual premium? The issue date? Any health risks changed in the client? All of that would matter for us to look at a way to reposition the cash that they have plus the premium to see if we could do better for them, or not. And that's really all you're looking to do.
Can I ask you a quick question, Phil?
Yeah, what's up?
On a product like this, who is your go-to for something of this particular scenario that you've got here? At that
So,
age of 45, 46 years of age.
yeah, I mean, so it goes back and I'll preface first, this is the political answer. Um, in 18 years of doing this, not one client has ever been the same. However, if I were to explore options for the client, so say this client is a 45-year-old male, I think it is.
You're right.
Yeah,
45,
40.
46, yeah.
Yeah.
Yeah, 45,
So,
yeah.
yeah, so what I would say is two things. One, if they can afford 21,360, then I would say let's do something along the lines of accumulation. So a lower face amount, higher accumulation, and then supplement the rest with term. And so I wouldn't even do this design. This is more of a death benefit focus. And so with something like this, I'm looking more towards the 50s and up for people who probably have their retirement okay. So someone with the whole life concepts, you have your people who do infinite banking, and that's like your 30s and 40s. But usually, if it's that type of premium, the face amount is dramatically lower. So, so I would do a combination of perm, whichever your client likes better, and term to meet the requirement to have them protected in case they don't make it home tonight. Who do I like most for
Okay.
that? I like Corbridge because they have the living benefits on their term. It's dirt cheap. And then they also have a pretty solid accumulation product. I have it for my boys, and I got pretty decent returns over the last year. So, double digit returns. Now, next year or this year, with all the tariff crap going on, I highly doubt I'm going to get double digit returns. But I do center mostly around the S&P 500 now, comparatively to a lot of the IUL carriers who focus on their proprietary indexes. I've seen those, and statistically, they show lower returns in the long term. That's why I like to stick with, the tried and trues like S&P. Um, Symetra has NASDAQ, in their policies as well. So it can really help with the value proposition of giving someone the right thing. So if it were me and I was talking to this 45-year-old person, I usually look at Corbridge, Symetra, North American, Columbus, and National Life Group. So those are the five I usually look at from the IUL side. From the whole life side, I usually look at Lafayette. So I just have to get access back. Usually
Right.
I don't sell a lot, but in order for me to get their software, I have to recontract. It's a pain in the keister.
Right. Right. Right.
Um, so does that help? That um, it really depends. There's a crossover for certain customers. So like cash accumulation, you have probably, 20s if they're doing really well, usually mid 30s all the way up to about 50, maybe 55, depending on how much they have to save. But then really about 40 to about 70, you have that different focus which is death benefit based. We do have some carriers that can go all the way up to 90, but that would be more of an estate planning, high end, high ticket type of sale. If they're older, they're probably looking for some type of estate planning purpose. So it just really depends, but it's a great question. It is subjective. There's a lot of people on this call who will pick a different carrier. Like if I told everyone right now, hey, I got a 45-year-old and they're looking to do X, Y, and Z, you'd see different results even if they pick the same carrier. So it's kind of funny. Sometimes I do that. Like I did that when I ran an internal sales desk. I would send everybody a quiz and I would say, hey, I got a client who's this, and that. Uh, go. And then we would just kind of go back and explain why each person picked what they picked. And you'd be amazed at the different reasons why everyone picks something different, but it's kind of fun. Um,
Yeah. Are you picking some of these because I know we talked yesterday about Crohn's and things like that. Are you
yeah.
picking them because of the underwriting is not as stringent as others per se?
Well, and that's a great
How
question. That's the other side of the coin, like why I would pick certain carriers over others. So for me, I'm substandard because of my weight. So I would pick Columbus because on their IULs, they take table shaves C, B, and A and move you to standard. Okay. So that would be someone for me. But someone who's healthier, usually my top two would be Corbridge because of the living benefits, and then Symetra because of the cost, but they don't have living benefits like Corbridge does. So there's a couple, I guess you would say, lead dogs that a lot of people have, and that they kind of position, but it doesn't mean they're the best in all scenarios. So like for me, that's why I like using the software. Um, for example's sake, like if I look at, so I think this was, oh, Nana, yours didn't save earlier. But let's take 45 Phil Resch, and we'll see here what I ran. So I ran an illustration design for a standard non-tobacco sulfur premium on a $1 million face. And so this is death benefit focused for a 45-year-old. And, went through just an annual pay, all years level, no disbursements, no riders, and it's me. So then you can pick your carriers here. And, I went through with the death benefit focused carriers. So Columbus only has one product, really. It says now, plus, now. They're all the same. I don't know why they have like six different iterations here. But Valley Plus from Corebridge, protection. These are all protection based. So I went through and what this does is, one, this software cycles through several carriers at one time. I put the parameter in and then they do the rest. So it'll show you by initial premium, uh, target what I would make on the case, um, you know, obviously I care most because if it was for me, I care about premium and pricing. But what you'll find is a lot of times Symetra usually comes out on top from a death benefit focused product standpoint. They have a very cost efficient product. So if I modified this, and this is Corebridge's Value Plus, it's not their QOL Value Plus. That should be in this software that I have, hopefully by the end of the year. They said first quarter, but I used to work there, so probably end of the year. But as you can see, they're the top two in protection products. If I add the QOL version, it'd probably be like 8,200. So it's still competitive with living benefits compared to the other carriers. So there's a great story to it for both products, and that's why I say all things considered, on a preferred male, the lead dogs I've seen are Symetra and Corebridge from a cost perspective. Um, does it mean it's the best? No. Again, it's subjective. So I work a lot with the Indian community. Diabetes runs rampant in some situations. So you might be looking more at North American or Columbus, comparatively speaking. So just because the substandard risk classes would knock Symetra and Corebridge down, and some people get insulted by seeing the word standard, even if the pricing was cheaper with Corebridge or Symetra, if it's a table C, it still might be cheaper than North American or Columbus, but some people will still would rather see the word standard than a substandard risk class. It's actually really funny. Prudential is that way. They'll take a lot of risk, but their pricing is just different. I'll put it that way. Um, but yeah,
Just
go ahead.
just an observation, yeah. This is an overview observation. When I'm looking at initial annual premiums here and target premiums,
Yep.
whenever we're running these policies, I seem to be the target premiums that we keep coming up with are pretty low compared to even the initial premiums. What's the relationship between the two numbers there?
So, and that's an interesting question because you'll see a lot of debate online with people who so say for example, say this is 7222. The target's actually 5 grand more, but 7, 8, 9, 10, 4 grand more.
Yeah, four.
Um, but I said I want to see the premium to get me to 100 or 105 or 121, and you'll see guaranteed years 36, non-guaranteed 75. So you'll see a debate online with people where they're like, "Oh man, so and so ran this poorly because look at the cash value in the first 6 years. Oh, that person is robbing the client." I'm sitting here going like, what's the objective? Is the objective for this high of a death benefit? If that's the case, let me go down to the actual illustration, which is down here. A lot of scrolling. Sorry if anyone's getting car sick. Getting there. All right. So here, you'll see in the 0% column, I have a death benefit all the way to age 80. Okay, so I need 36 years of absolutely no returns and guaranteed charges from day one for that objective to hit, and that's the average male mortality, 78 to 82. Over here, I've got cash money rolling at a 6% rate of return. So you don't need to always fund it at target. What you find is some agents will say, oh, you have to fund the first year at 11,724, then the following years will drop to 7,000. It's a target play. The cool thing about these carriers is they have rolling targets. So you get paid 7,000 in the first year, and then year two premium comes, you're going to get 4,000 more dollars to make yourself whole. So you're going to get the money. You just like there's so many times where I've seen people would put the first year premium as the target and then drop it when you could just have it be the level premium and not have to try and make up excuses with the client. But Nana, for to kind of revert back to your question, every carrier picks where they want to be better or worse, including targets, premium, all that stuff matters because behind the scenes, all these carriers are looking at cells. Okay, am I going to be good in preferred and preferred best, but maybe I will sacrifice standard? Whereas someone else might say, I want to be in the standard category, the best, but the other two, not so. Then you have specific age ranges, and so they put money and dollars towards different cells and different areas. That's why there's people behind the scenes at every insurance company that are running quotes and systems like this to see how their product stacks up and compares against the competition. They call them heat maps. And so where some carrier wants to win in certain places, other carriers will pull back because they might want to win in different areas to all balance out the portfolio. So it's a hard question to answer regarding target premiums for clients and why they're different or why does it matter? Like it's all a carrier algorithm. And I'll give you a good example. I had a case with Symetra where it was a $35 million case. Target premium was going to be like 800 grand. And basically, Symetra told us that we can't do the five pay. It was going to be 900,000 five pay. Symetra said we need more money because the product is too good. So they told me I had to put 1.47 million in to get that $800,000 target. Um, and I said, you guys got to fix this. And they said, all right, well, we'll try and adjust it on our end and what's acceptable. They did a term perm blend and brought both the target and the premium down. The target went down to 600,000. They're like, oh, look, the client only has to pay 800,000 now. And I was like, guys, I know what you're doing. You're saving money on the target. And so some carriers, like if you add a term blend in, will shave off your target premium too. And the client got so pissed off with the pricing that that went out the window. I'm still a little salty about that. That was a year and a half of effort gone to nothing, but a good lesson. And I'm assuming that, everything happens for a reason. So maybe someday that'll come back around and I'll win something from that standpoint. But it just goes back to pricing where people want to win. There's actuaries that are all involved. That's why whole life is so complex. There's actuaries involved. It's like putting a cuckoo clock together, you know? So all that stuff is just ties in. It's beyond my level of scope. That's why I like this side on the sales side. I don't have to figure all that crap out. I just have to sell them.
Philip, just
So
going back to the multi-company illustrations that you just ran, I want to say that that's a paid subscription.
yeah, this is 215 a month.
$250 a month. Okay, gotcha. Okay.
Yep. Yep. So, same thing. Like I said, there's Annuity Genius 165. So it does the same thing just with annuities, multi annuity run. We're gonna have a package too. If you get the Annuity Genius, the Insight, and we have a marketing package, so a CRM, build you a website too. All that would be about 550 a month. So it drops off about $30 between Insight and Annuity Genius when you combo those with the the CRM package. So we're doing a lot of stuff. We'll talk about the great collaboration too, but all encompassing opportunity to help you guys make money.
I have a question, Bill.
Yeah, what's up?
When you are speaking with the client, how much of the weeds are you getting into, um, as far as all of that stuff? Like,
I'm
are
not.
they okay? That's okay.
Yeah,
That answers my
yeah.
question.
Yeah, so like if I were talking to good old Phil Resch on this, and I'm not trying to push this, but I'll show you something cool that it does as well that I think would help you, Tia, from that standpoint. So let's just say, for example's sake, I want to build out an illustration here, and I'll just say DB focused. Okay, I hit next, import presentation. And what happens is it creates this little, like, I can create charts for each carrier. So like I'll integrate what I want to see on the chart. So cumulative premium, let's just say um, non-guaranteed net surrender value and death benefit, and hit apply. And it'll basically turn into a presentation that you can email to a customer. So they can go through the illustrations if they really want to, or what I do is I kind of guide them to the spreadsheet. So I'll say, here's a spreadsheet, here's a guaranteed initial premium, here's your total guaranteed years. You can even add back into the settings the non-guaranteed, but then it has the chart so you can see, all right, so I spent this much, you know, and here's your non-guaranteed surrender value. So that continues to go up. So by 75, I've got the most cash inside of Symmetra, cumulative premium. The least amount of premium is Symmetra, and the net death benefit stays the same for everybody at a mill. So if you sell the sizzle, you know, the steak doesn't really matter because you can pick your favorites at that point, and as long as
Mhm.
it's within their budget, they're going to take it. So, for a 45-year-old, it's all about that dance we've talked about on prior calls. Um, it's a situation where, I would say to Phil, I'm like, tell me about yourself. Because let's be honest, everyone wants to talk about themselves. So tell me about yourself. What do you do? How's your retirement looking? Not really yes or no questions, but more or less you're trying to find spots where you can integrate an opportunity. All right, Phil, it sounds like you have a really good setup for retirement. Between the pension that you're getting from your job, your 401k, it sounds like you have a great story. Now, let me ask you, Phil, what have you done to protect that asset against the unexpected? What do you mean? I'm talking about long-term care. Long-term care has increased and grown over, 480%, whatever the number is, comparatively speaking to inflation and other things. It's a huge issue. So the worst thing that could happen is you have an unexpected long-term care incident, and that will completely erode your entire retirement portfolio. Did you know that we have products that now that you can get that long-term care type solution that if you don't use it, you don't lose it. It'll build cash. And if you have, say, an unexpected mortality early, it'll pass on a tax-free death benefit to your spouse and or kids. and it's an all-encompassing package, and it's pretty cost efficient given, your current age. Are you interested? What's your budget? Let me show you some type of solution. So you kind of build out from there
Hmm.
what you want to show them. And so that would be the initial fact finding phase. Fact finding phase, yeah. Um, and then after that, if you're quick enough, you can do it on the fly, or you're going to say, all right, I want to analyze this. I want to find the best possible opportunities. How does next Tuesday sound? 10 o'clock, coffee on me, whatever.
Got it.
So, yeah, it just depends on how fast you are getting the illustrations out. Like, obviously, I've been doing this for almost 2 decades. Good God. Yeah, I started when I was 10, but no, with that, I can do it with WinFlex too. So the free version, if you will, but it just takes more massaging. This obviously is very quick and helpful, but I can do it here too. So it just depends on the timing, and it depends on the conversation that you're having with the client. How close are they? Are they constantly looking at their watch as you're talking? So you
Mhm.
can you can pick up the cues when you're talking to people if they're more business focused and oriented versus like relational and will spend more time with you.
Got it. Okay.
So, um, yeah, and so Roshni, I know you put a question in the chat. Is it okay to show illustrations on the first meet, or should we wait? Um, Really, that's something that I would say you'd play by ear. So if you're using, say, a pad and pen to talk about things, like what are your concerns? What are your fears? Based on this, we should look at this. What's your budget? That would be conversation that if you're quick enough, go for it. Because if they're showing you buying signs, why would you wait? Right? But if you haven't practiced enough and you haven't hit the marker to run either multi-carrier or have a good educated guess with, say, a lead carrier, then it's only going to hurt you in the long run. You'll be like, okay, hold on, wait. And then they're just going to sit there, twiddling their thumbs. And it could lead to what I would consider a bit of unprofessionalism, if you're trying to futz around with illustrations. So I would say in the beginning, you probably want to play it safe and come back to them. Could even be the next day, or something like that. But you always want to make sure that every time you leave, there's an action step for the next conversation. Because if you don't have an action step for the next conversation, there won't be a next conversation.
Philip, talking of which, would it be possible to, like, I think you talked about this earlier on, where you threw out certain scenarios and then asked us to run different illustrations.
Yeah.
And I know from a personal perspective, I'm beginning to get the gist of illustrations and how they work and that. But I think it would be a good homework for us to
Yeah.
practice as well.
I mean, I'm always willing to give those scenarios out. It would just be a matter of those who are willing to want to do that, right? So, I mean, a lot of you have been on several calls, so very similar group of people that we have on a night. But I'm willing to give out, I guess you would say, a homework assignment if you guys want, and then we could go through it next week. So it just really depends because this time is for you guys. Any questions you've asked, any questions you want to ask, I'm all for it. It just depends on if everyone finds that to be a good value of time, we can totally do something like that. And like I said, it's interesting because everyone will have a different response. And what I would do is I would just tell you guys to email me, and then I can show what different people ran, and then, just kind of ask people, why they pick that, right? So it's kind of like an iron sharpens iron. That's what this whole night is about, as opposed to like tomorrow's, which are a little more polished or sales ideas or, product. This is more raw and open. So if people are down to do something like that, I'm more than willing to give out homework. It's completely up to you.
So Zach,
So,
and then circling back to Ned Law, in
mhm.
so I've just started working with a client on Ned Law for the first time.
Yeah.
Is there any sort of parameters within which, in terms of net worth or asset structure, does Ned Law not work for a particular client? Is there some sort of a guideline that we should be using there?
So net law is basically for wills and trusts. Like it's not in its living trusts, it's not like your estate planning. Um, like I would never go to net law for ILITs, right? Or grantor trusts or, even I know they have a package for it, but the special needs trusts. I would rather I would rather have someone who is experienced in those specific areas. So NetLaw is fantastic for your real basic stuff. So we talk about putting your assets in a house or your house, your assets like your 401ks, your IRAs, and all that stuff. That is totally fine. But if you're talking about how you want to avoid estate taxes, gifting, and in scenarios like that, it's not really the place. So if you have someone who's got like 3, 4, 5 million, you probably want to get the basics done, but then, have a bit more of a educated conversation on maybe some additional type of strategies, maybe a gifting strategy, maybe something like um, you know, leveraging, different types of resources and opportunities that are out there. So yeah, I would say that's a different animal from that standpoint. For those who don't know NetLaw, we do have NetLaw that is available. It's online wills and trusts. If you want to get it, well, let me just show you real quick because I'll show it, share it. If you want it, you get $200 every time someone buys a $600 package. It's pretty basic and straightforward. So, NetLaw Advisor, signing in here as the advisor, and I will share the link here if you want to get registered. It's right there. But basically, here from this standpoint, if I hit this plus sign, I can send to whoever, let's say Phil Resch, email and phone number, an option to go and purchase a package. Now, if I go back and let's see if I can do this the easy way, client, this would be the client view. So you would open up your profile, you would start building out your profile, you put your family's information in, and you would purchase a plan. So this estate plan is just a will, healthcare POA. You have living trusts in here. It's $600. And basically, the thing about this is, for those of you who don't know, the top guy who wrote about 600,000 in QOL business last year did it all by soliciting net law opportunities. He sat down with the client, just sold them the will and trust package, and then from there went through line by line with everything to get them set up with the wills and trusts. And then it was, all right, here's where you put your life insurance in. You don't have life insurance? that's something we should talk about, and you write it down. If your kids are going to a different guardian, we should call them right now. Okay? You call them right now, say, hey, Phil and Danielle are putting their kids with you in case something happens. I think, let's say Nana is doing this. I think, Nana should come over and help you guys with this as well. So it's lead generation by friends and family referral opportunities. But usually, when you do this with someone, it's about 2 hours. You go through the whole process, but it's all uncovering their assets at the same time. So you know what they have in 401ks. Do they have any old 401ks? Brokerage accounts, because you need account numbers, the whole 9 yards. So it's a way to prospect and grow just by offering a will and trust package, which, if you think about it, my wife and I, we did our will and trust package through a fundraiser, and we did a silent auction. It was a $2,000 power of attorney, health documents, will, and done by a lawyer, and we got it for $75. So no one else bid on it. We were like, oh, sweet, But even so, this type of value proposition at $600 is giving you a better story than what you go with most lawyers. And all you have to do is complete it and then get it notarized. So, definitely a good arrow to have in the quiver. It's free to get signed up and everything, and you're on your merry way. But kind of going back to conversation, like Nana, what you were saying is this is still more basic as opposed to advanced. So I wouldn't go too crazy with this, is the best way to put it.
Appreciate your response, Philip. Thank you.
No problem. Was this helpful? Do you guys like stuff like this too? Is this okay? Cool. I think this would be very helpful. Jessica, I bet this would be pretty good for your target market as well. So,
Yeah, I do a lot of estate planning stuff with my market.
yeah. So this, I mean, this is quick dollars. So you talk about a good way to get a value out of your time, even if they don't buy an insurance policy because they're declined or whatever, you're still walking away with at least $200. So
I'm a
not a bad
notary
day.
too. So a lot of the estate planning stuff that I do, I come in as the notary. So I bring them all of the documents, or one of my notaries bring them all the documents. We walk them through how to do it, and then we notarize them. And actually, a lot of the business that I get is through my notary work. So I get called to like hospitals and stuff a lot to do power of attorney. So whenever I get called to do a power of attorney, I always ask about a will and a trust. Same thing if they have me come to do a will, I'll ask about a trust. And then that's how the conversation usually starts, is through notary work for one of my demographics.
Ah, just
My notary too.
yeah, see. Well, fortunately, she's in Rhode Island and you're in Houston, so there's no conflict here unless, for some reason I don't see a conflict happening, but we're all friends here. Um, So yeah, I mean, just a great story altogether. I think that this is a great value add that you could incorporate in the practice to really, again, as I always say, it's all about the community, right? You want to take care of the community will take care of you. And that's the most important part about all of this. So
I want to give a comment, Phil, if it's okay, to whoever it was that asked about showing illustrations on the first meeting. If
yep.
you're like, if you have a lot of time restraints, one of the things that I do that works for me is whenever I get a referral or someone reaches out to me, I have an intake form. And so I will send them the intake form that has all of their personal information on it. They can put all their assets, all of their debts, their liabilities, all of their goals, and I have them rank out on a scale of 1 to 10 how important each of their goals are. So they get that back to me before our first meeting. I let them know, like, hey, at our first meeting, we can sit down and we can do this together. But if you would like to kind of expedite the process a bit, if you get this to me 72 hours before we meet, when I come to you, I can already have a proposal. And that's very helpful.
Yeah, I put that in the chat. So something similar. You know, so it's F&A, financial needs analysis, whatever you want to call it. It gives you kind of like the goals and dreams, what's your income to debt ratio and things like that. So yeah, very similar setup, and it's a great way. Another thing you can always do is have an agenda. Like it never hurts to have an agenda of what you plan on talking about. Um, but yeah, these are definitely ways to help you streamline the process and get ready for the presentation. So yeah, that's a great comment, Jessica. Hats off. So
Philip, did you just say that you put this out on the group chat? The
it's
FNA?
in the meeting chat. So if you go to your meeting chat, you should be able to see a little Excel document there. Do you see it?
Yeah, I see that. Are we able to download that?
Yeah, just click on it.
Okay, got you. Thanks, Philip.
No
Appreciate
problem.
it.
No problem. Any other questions? I know we're hitting an hour and 20, and this has been great dialogue, but I just want to make sure, um, you know, I don't want to bore you guys either. So I'll ask who wants to do the homework. I saw a few people here. So Roshni, Shweta, Nana, Aju, okay, Tia, okay. I'll uh I'll put together a little something. If you guys want to participate, great. Not, but I'll just send an email to everybody who is here, and don't reply to all. Okay, just reply to Phil, and then we'll do it next Wednesday so we can see kind of where people are at. So I'm gonna write that down. Do homework on case design. Cool. All right. Well, I was gonna say if no one has any other questions, I think we'll wrap for the evening, unless no one's got anything else.
Sorry, Philip. It sounds a little crazy. I tried to download that file while I'm on my phone on Zoom, and I go
Don't do
down.
it on your phone. I'll
Don't.
email it to you. I'll
Okay.
email it to you. Yeah. So,
Okay.
all right. Well, if again, so one thing I'll tell you, this will be uploaded to the YouTube channel, so at Valor Financial. So we got all the videos here. It'll be under this ugly camo looking color, back to basics. But we'll just keep continuing to add to the repository of information. We'll have a presentation tomorrow. Tomorrow we're going to have alternative investments on. We've got an organization that's also going to be at the Great Collaboration. He's going to give a little teaser, if you will, tomorrow at 4 o'clock about how we can utilize different type of land developments. So we'll talk more about that. And again, if you haven't done it yet, get it while it's hot. TGCconference.com. Hit register or register right there. Love to see you guys. Day and a half of awesome funsies, good information to help you guys get in front of more clients. So appreciate the evening. As
Hey,
always,
hey, Phil.
yo,
Hey,
Thank you.
with that discounted rate for the hotel,
yeah,
what is the discounted rate you said?
169.
Is that the like regular um, room or
300 is the normal.
okay?
Yeah. So, but it's a great place, resorty kind of thing. I think you like it. If you want to find a place around, go for it, but it'll be probably around the same price point, maybe a little less, but it's a nice area.
Well,
So,
we're planning to come Friday, so
well, might do a little awards ceremony kind of thing for Valor peeps. So obviously you'd be invited. So,
myself and
uh,
John will be there
oh,
Friday.
John's coming. Oh,
Oh, No, Phil, I'm not coming. Want to be there?
Better be there. So, all right, guys. Well, have a good night. Looking forward to it. Holler if you need anything, and we'll see you next week.
All right, Phil.
Thank you.
See you guys.